Good day, everyone. Today, we are going to discuss one of the most fundamental concepts in civil law, obligations, based on the Civil Code of the Philippines. This topic is very important not only for your law subjects, but also for accounting, auditing, and business applications. Let's begin. Under Article 1156 of the Civil Code, an obligation is defined as a juridical necessity to give, to do, or not to do. Let's break this down so you can clearly understand it. First, the word juridical. This means that the obligation is recognized or created by law. It is not just a simple promise or moral duty, it has a legal basis. Second, necessity. This means the obligation is enforceable by the courts. If a person fails to comply, the injured party can go to court and compel performance or demand compensation. Third, we have what we call prestation, or the subject of the obligation. There are three kinds. To give, for example, delivering a specific car. To do, like rendering a service. Not to do, such as agreeing not to build a structure beyond a certain height. Now, let's focus on the phrase juridical necessity, because this is what distinguishes a civil obligation from other types of duties. When we say juridical necessity, we mean that if the obligation is not fulfilled, the law provides remedies. These remedies include specific performance. Here, the court compels the debtor to comply. Another one is for damages, which involves payment for losses suffered, and other legal remedies depending on the situation. Now, this is very important. Not all obligations are enforceable in court. So we have to distinguish civil from moral and natural obligations. Civil obligation is basically what we mean in Article 1156. Since we already discussed juridical necessity, this means that a civil obligation is one that is legally enforceable. Let's look at some examples so it becomes clearer. A loan agreement. If you borrow money, you are required to pay it back. Also, a contract to deliver goods. If you agree to deliver something, you must fulfill that obligation. Another one is a case of negligence, like a car accident. If you cause damage, you may be required to pay for it. Just remember that when we talk about civil obligation, it is enforceable by law. It has legal consequences in case of non-compliance, and it arises from specific sources, which will be discussed in the succeeding slides. Now, what are moral obligations? These are duties based on conscience or ethics. Example, helping a friend financially. If you fail to perform this, you cannot be sued. And how about natural obligation? Under Article 1423, these are obligations that cannot be enforced in court, but once voluntarily performed, they produce legal effects. Meaning, you cannot be forced to perform it, but if you choose to perform it, you cannot take it back. Examples, payment of a prescribed debt. Suppose Anna owes Ben $50,000. After 10 years, the debt is prescribed, meaning Ben can no longer file a case. If Anna still chooses to pay voluntarily, she cannot demand the return of the money. Another example is the payment of legacy, despite void will. Let's say an heir receives $100,000 inheritance, but pays $150,000 of the deceased's debts voluntarily. The excess payment cannot be recovered. Just remember this key difference between civil, moral, and natural obligations. Civil obligations, enforceable. Natural obligations, not enforceable, but has legal effect once performed. Moral obligations, these are purely ethical, no legal effect at all. After defining obligations, let's now discuss where these obligations come from. Let's now proceed to the sources of obligations. Under Article 1157, obligations arise from law, contracts, quasi-contracts, delicts, quasi-delicts. Take note. This enumeration is exclusive. This means obligations can only arise from these sources. Let's discuss it one by one. First is obligations arising from law. Under Article 1158, obligations derived from law are not presumed. Only those expressly determined in this code or in special laws are demandable. This means that obligations arising from law are imposed directly by statute. There is no need for agreement between parties. However, the law is very strict here. These obligations are not presumed, meaning, if there is no clear legal provision, then there is no obligation. It must be clearly stated in legislation. Examples, payment of taxes. Even if you never agreed to it, you are still obligated to pay. Another examples are support between family members, employer obligations under labor laws, and duty to register births, marriages, etc. Here's the key points to remember. Obligations arising from law. must be expressly stated in law and cannot be based on assumption or implication. Now, let's move to the second source of obligation: contracts. Under Article 1159, obligations arising from contracts have the force of law between the contracting parties and should be complied with in good faith. The phrase, "have the force of law," means once you enter into a valid contract, you are bound to comply with it as if it were law. And once validly entered into, it becomes binding like law between them. However, contracts must still comply with law, morals, good customs, public order, and public policy. Some examples of this are loan agreement in which you are obliged to repay. So if you borrow money, you are legally bound to repay it according to the terms agreed upon. Another examples are sale, in which the obligation is to deliver and pay, and also lease, which involves the obligation to pay rent. Here's the key points to remember when it comes to obligations arising from contract. It requires consent, object, and cause. It must be performed in good faith, and parties are bound to their agreement. Now, for the third source, we have quasi-contracts. Under Article 2142, certain lawful, voluntary, and unilateral acts give rise to the juridical relation of quasi-contract to the end that no one shall be unjustly enriched or benefited at the expense of another. So what does this mean in plain language? Simply put, no one should benefit at the expense of another without a valid legal reason. The key thing about quasi-contracts is that, unlike ordinary contracts, there is no agreement between the parties. Nobody sat down and made a deal, nobody gave their consent, and yet, the law steps in and says, "Hold on, this situation is unfair, so we will create an obligation." Why does the law do this? The purpose is clear: to prevent unjust enrichment. In other words, the law ensures that no one can gain unfairly at someone else's expense. Even though there is no contract, the law recognizes that fairness requires a duty to perform. Just remember the key points. It must be lawful and voluntary. There's no prior agreement. It is based on equity and fairness, and its goal is to prevent unjust enrichment. And the Civil Code classifies quasi-contracts into two types. The first one is solutio indebiti. Under Article 2154, if something is received when there is no right to demand it, and it was unduly delivered through mistake, the obligation to return it arises. Meaning, a person receives something that he has no right to keep, and it was given purely because of a mistake. For example, suppose you intend to send 10,000 to your friend. However, you accidentally type the wrong account number, and the money is transferred to another person's bank account. The person who received the money did not earn it, did not lend it, and has no legal right to it. Therefore, they are obligated to return it to you. Key points to remember in solutio indebiti: payment was made, there was no obligation to pay, and payment was made by mistake. Take note that if payment was intentional, not by mistake, there's no solutio indebiti. The second type of quasi-contract is negotiorum gestio. Under Article 2144, whoever voluntarily takes charge of the agency or management of the business or property of another, without any power from the latter, is obliged to continue the same. Meaning, a person voluntarily takes care of another person's property or business without being asked or authorized, but does so for the benefit of the owner. In simpler terms, this happens when you step in and help manage or protect someone else's property, even if they did not give you permission, usually because they are absent or unable to act. Because of this, the law recognizes that your action was done in good faith, and it creates certain rights and obligations to ensure fairness. For example, your neighbor is out of town and their house is damaged by a storm. You decide to repair the roof to prevent further damage. Even if your neighbor did not ask you, you acted to protect their property. When your neighbor returns, they may be required to reimburse you for necessary and reasonable expenses. Key points to remember in negotiorum gestio: there is no authority or consent. The act must be voluntary. The business belongs to another, and the owner is absent or unable to act. But you need to be careful with the limitations. If you ever decide to take charge of one's property, you must continue the management until the owner can take over. You must act with proper care or diligence. If you act negligently, you may be liable for damages, and if your actions are not beneficial, you may not be reimbursed. Here's the key idea for you to remember. Solutio indebiti is about correcting a mistake to prevent unjust enrichment, while negotiorum gestio is about helping another person without authority, but the law ensures that fairness is still observed for both sides. Now let's move to another source of obligation, delicts, which are obligations arising from criminal acts. Under Article 1161 of the Civil Code, civil obligations arising from criminal offenses shall be governed by the penal laws. This means that when a person commits a crime, they are not only liable for criminal penalties, but also incur a civil obligation to repair any damage caused. In other words, civil liability is automatic alongside criminal liability. Examples of this are theft, there's obligation to return the stolen item and pay damages. Physical injury, there's obligation to pay medical expenses and other damages. And fraud, where there's an obligation to restore the defrauded party to their original condition. Your key points to remember here are: civil obligations arise directly from criminal acts. The offender is liable to the victim, separate from criminal punishment. And the victim has the right to claim compensation through civil action, even if the offender is being prosecuted criminally. Whenever analyzing obligations from delicts, always remember, crime leads to criminal liability, plus civil obligation to repair damages. This ensures that while society punishes wrongful acts, the victim is also protected and compensated. Now for the last source of obligation, we have quasi-delicts, which are obligations arising from negligence. Under Article 2176 of the Civil Code, whoever by act or omission causes damage to another, there being fault or negligence, is obliged to pay for the damage done. Such fault or negligence is called a quasi-delict. This means that even if there is no contract between two parties, if you act negligently and cause damage to someone else, the law imposes an obligation on you to compensate the victim. Basically, a quasi-delict is based on fault or negligence, not on agreement or criminal intent. The key idea here is fairness. If you cause harm to someone, even unintentionally, you must repair the damage. Examples: reckless driving, like hitting a pedestrian. You have an obligation to pay for medical expenses even if there's no intent. Another examples are careless handling of another's property, breaking a neighbor's window. You have the obligation to replace or repair it even if you didn't intentionally break it. And negligence in professional service. A doctor's failure to exercise proper care, causing injury to someone, makes him liable to pay for the damages. There is also a special rule under quasi-delicts which addresses employer liability, known as vicarious liability. Under Article 2180 of the Civil Code, the master or employer is responsible for the damage caused by his servants or agents in the exercise of their functions, or by reason of their employment. This means that if an employee or agent, while performing their job, acts negligently and causes damage, the employer can also be held civilly liable for the harm. Here's the key points you need to remember about employer liability under quasi-delicts. First, there should be an employer-employee relationship. There must be a recognized employment or agency. Second, the act must be within the scope of employment. The employee must be acting in connection with their work duties. And third, there must be a negligence or fault, meaning the employee's careless act must have caused the damage. Now, what's the defense of employer in this case? An employer may avoid liability by proving that they exercise due diligence in selecting, supervising, and controlling their employees. To sum up our discussion about obligations arising from quasi-delicts, here's the key points you must remember. Quasi-delicts arise without a contract or agreement. They are based on fault or negligence, not criminal intent. They ensure fairness by requiring the person at fault to repair the damage. And employers can also be vicariously liable for the acts of their employees, but they may defend themselves with due diligence. So, class, whenever you see a scenario where someone causes damage by mistake, carelessness, or negligence, even without any agreement, the law imposes an obligation to compensate. And when differentiating delict from quasi-delicts, just remember this: delict arises from a crime, while quasi-delict arises from negligence. Even if the same act exists, they are separate sources of obligation. Now, let's connect this discussion about obligations to accounting, especially for BSA and BSAIS students. In relation to trade payables usually arise from contracts, such as purchasing goods or services on credit. For example, imagine a company purchases inventory worth $100,000 from a supplier, but instead of paying immediately, it agrees to pay after 30 days. Even if no cash has been paid yet, the company already has an obligation to pay because there is a valid contract. Because of Article 1159, these obligations are legally enforceable and considered juridical necessity. So in accounting, When the company records accounts payable, it is recognizing a real legal obligation, not just an estimate or assumption. Now let's also relate this to accrued liabilities. Accrued liabilities may arise either from law or contracts, and even if not yet paid, they already exist as obligations. Let's say a company earns income this month. Even if the tax is not yet due or paid, the company already has an obligation to pay taxes to the government. This obligation arises from law, so it falls under Article 1158. Another example is, suppose employees have already worked for 15 days, but payday is still at the end of the month. Even if salaries are not yet paid, the company already has an obligation to pay those earned salaries. So in accounting, we record this as accrued salary expense. So class, the important thing to remember is this. In accounting, we recognize obligations as soon as they exist, not only when they are paid. Because under the Civil Code, if the obligation comes from law or contract, and it already exists, then it is already a juridical necessity, meaning it is legally binding and enforceable. Now for the last part of our discussion, let's briefly discuss the difference between legal and constructive obligations, because this is where accounting and law differ. First, let's talk about legal obligations. A legal obligation is one that is based on law or a contract, enforceable in court, and recognized under the Civil Code. In simple terms, this is a real obligation in the eyes of the law. If you fail to comply, you can be sued and compelled to perform or pay damages. Now, on the other hand, we have constructive obligations. These are obligations that are based on established pattern of past business practice and published policy, not legally enforceable, and is recognized only in accounting, particularly under IAS 37. So even if there is no law or contract requiring it, a company may still recognize an obligation because it has an established practice, and as a result, customers expect it. For example, a company sells appliances with a standard 1-year warranty stated in the contract. That 1-year warranty is a legal obligation because it is part of the contract and enforceable in court. Now, suppose the company has a consistent practice of repairing or replacing products even beyond the 1-year warranty period just to maintain customer satisfaction. Because of this consistent behavior, customers now expect that the company will continue honoring repairs beyond the contract period. Under IAS 37, the company must recognize a provision for warranty costs beyond 1 year. Why? Because there is already a constructive obligation. The company has created a valid expectation that it will continue this practice. In short, accounting recognizes both legal and constructive obligations, but the Civil Code recognizes only those that are legally enforceable. That ends our discussion. Thank you for listening, and I hope you learned something from this video lecture. See you in the next module.